Hello, everyone, and welcome to today's ALTA Insights webinar. These are ALTA's presentations we offer on issues important to title and settlement professionals. I'm Jeremy Yohe, ALTA's Vice President of Communications, and today we've got a great webinar lined up that concludes a four-part series that discussed insuring Native American land. Before starting, I do need to touch on a few housekeeping items. A copy of today's presentation can be downloaded from the handout section of the GoToWebinar window. If at any time you have any questions, please submit them through the questions box. We'll hold some time at the end for Q&A at the end of the presentation. Today's webinar is being recorded. You'll get a link to the recording in an email tomorrow, and you can always find an archive of all of ALTA's webinars at alta.org/webinars. And in that email, we'll also include a link to a page where you can access the previous webinars as well. And with that, I'll step to the side and turn it over to Megan, who will introduce the speakers.
Thank you, Jeremy. My name is Megan Powell. I'm a commercial underwriter for First American Title Insurance Company, and I also serve as vice chair of the ALTA Native American Lands Work Group. So joining me today as other speakers, and you guys can sort of maybe raise your hand when I say your name, Cindy Guanell, Regional Underwriting Director with First American Title, Orlando Lucero, Regional Counsel for F&F Family of Companies, and Nancy Appleby from Appleby Law in Washington, D.C., who is actually the chair of the ALTA Native American Lands Work Group. So I think we're going to go ahead and turn off our cameras here so everyone can focus on the content as we move forward. Okay. So in parts 1 through 3 of this webinar series, many different issues affecting the insurability of transactions involving Native American lands were explored by various speakers who all participate as members of the ALTA Native American Lands Work Group. In this fourth and final presentation in the series, we are going to apply the principles and issues discussed in parts 1 through 3 to 3 hypothetical transactions. 2 of those are commercial and 1's residential, and we'll evaluate how those principles and issues come into play in an actual transaction, as well as what may be required for insurability. As a reminder, the discussion by our speakers today is general only, and it's not intended to refer to specific underwriting standards or guidelines by a particular title insurer. If you have a transaction involving Native American lands, we urge you to communicate early and often in the process with your title insurer to make sure you understand the specific requirements for your transaction. And now Cindy will lead the discussion today with our first scenario.
Thank you, Megan. So in this first hypothetical transaction we're going to talk about involves the sale of a single family residence, which is located inside the boundaries of an Indian reservation. And this is one of the most common scenarios that we encounter involving Native American lands. So the threshold question is, what special underwriting considerations are present simply because the property is located inside the reservation? So we're going to talk about that. As our colleague Sean Holland discussed in part 1 of this webinar series, one of the most critical parts to understanding and underwriting transactions within the boundaries of a reservation is the vesting of the property. We must review the vesting deed to determine if the property is vested in fee, restricted fee, or in trust. In this scenario, there is no verbiage in the deed indicating that the owner is restricted from selling or encumbering the property. And there's no reference in the grantee clause to a trust relationship with the United States. So therefore, in this scenario, we're going to conclude that the property is vested in fee ownership, which we sometimes refer to as unrestricted fee when inside the reservation. In part 3 of the webinar series, Orlando Lucero noted that access to land inside the reservation has been a common source of claims for the title industry. And even if the property that is subject to the transaction is benefiting from an easement that takes it to a county road, you cannot assume that your access is insurable. Roads that appear to be public inside a reservation may in fact be constructed and maintained in reliance on an easement from the tribe. These kinds of easements are subject to federal regulations and they typically expire. In recent years, tribes in various jurisdictions have called attention to the public utilization of roads within their reservation in reliance on an expired easement. If you have insured legal access based on this roadway, it may result in an access claim under the title policy. For this reason, it's important to examine the legal right of access from the subject parcel to the public road all the way outside the reservation. If any part of that access route crosses Native American land that is held in trust or restricted status, the access right must be created in accordance with applicable federal statute. See Part 3 of this webinar series, which provides more detailed information about this statutory process and access over Native American lands. Megan?
Great. Thank you, Cindy. Okay, so let's talk about jurisdiction. Once you've confirmed that the property is owned in unrestricted fee and there's good access to the property, the next thing you should consider is who has jurisdiction over that land and what law applies to that property. For example, is the land subject to tribal taxes or assessments? That may not be something you know without doing research, so you should consider including a Schedule B exception for taxes and assessments imposed by the tribe, which can be cleared from the policy upon confirmation that none are owed, or alternatively, that whatever is owed is paid at closing. So now you've been informed that the purchaser of the residence and their lender want extended coverage policies that provide coverage for mechanics lien risk. This home was not recently constructed. However, you are aware that there has been substantial renovation by the seller during their preparation for sale of the property. Since you're inside a reservation, you can't automatically default to underwriting this risk pursuant to state mechanics lien law. You must first determine who has jurisdiction over the land. And that may vary from reservation to reservation depending on what the tribe asserts and whether there are tribal compacts, also sometimes called MOUs, with state and local government outlining an agreement regarding who will assume jurisdiction over what land. For this scenario, you learn that the tribe asserts jurisdiction over all land inside their reservation, regardless of vested ownership. So you find the tribal code online, but in your review of the code, you cannot find any law that speaks directly to mechanics liens. At this point, you must determine if you feel comfortable assuming mechanics lien risk under the policy, and if so, what you will require to mitigate that risk. This will most certainly require a discussion with your underwriter. You've also learned that prior to placing this home on the market, the seller subdivided their property. The transaction you're insuring contains a parcel of land with a residential home on it, and there's a remaining parcel that is a vacant lot and is still being marketed for sale. You already know, based on your prior analysis of the mechanics lien risk, that the tribe asserts jurisdiction over the land. However, you also note you're being asked to provide an ALTA homeowner's policy of title insurance, which provides coverage for subdivision violations. Rather than immediately rejecting the idea of providing the coverage, you first investigate to determine whether the tribe has a planning and development department. Upon learning that they do, you are able to get written confirmation in the form of an email that the subdivision of the land was completed in compliance with the tribe's regulations. This may provide you with enough comfort to provide the coverage. However, if you were unable to get this confirmation, you may want to carve out that coverage through a Schedule B exception. Another possible option is to modify the policy or an endorsement form that provides the coverage to clarify that the insurance is limited to compliance with state law only. The ALTA 47 series of endorsements and policy addendums can be issued with pre-2021 policy forms. These endorsements and addendums add new defined terms to the policy conditions, including the defined term state, which is used to clarify that the applicable law for determining coverage under the policy is the law of the state where the land is located. The 2021 policy forms have been revised to make this clarification, and therefore it's not necessary to attach an additional endorsement or addendum when using these forms. All right, Cindy, let's consider a different twist in our scenario here. I'm going to turn it back to you.
I'm sorry, I forgot to click my mute button. Okay, so let's change our fact pattern on this scenario just a bit. And let's say that upon receipt of the title order, you were informed that this land was originally an allotment parcel. Again, Sean Holland spoke in detail about allotted land in part 1 of this webinar series. So we know that allotments of reservation land were given to individual Native Americans historically, and that these parcels of land are typically subject to restrictions on conveyance and encumbrance of the property without approval from the federal government. In order to determine if this allotment parcel is still subject to such restrictions, you decide it's necessary to review the full chain of title back to the original allotment patent. It is possible that the restrictions on the allotment were lifted at some point and the property was sold as an unrestricted fee parcel. But as a reminder, these restrictions can only be lifted by the federal government, typically the BIA, acting on behalf of the Department of the Interior. However, many allotments are still in restricted status by their heirs, held by the heirs of the original allottee. In that scenario, it's important to include a requirement that the conveyance of the property be approved by the federal government as a condition of insurance. Slide, please. Thank you. On this slide, I have here a copy of an allotment patent, which includes the 25-year restriction on alienation of the property, which is highlighted in yellow. It's a little difficult to read on the screen, so we'll enhance that language. Here we go. So basically, in short, the pertinent language in that granting clause is that the patent grants to the allottee and his heirs forever, with the provision that the title hereby acquired shall not be subject to the alienation, lease, encumbrance, but shall be and remain inalienable and not subject to taxation for the period of 25 years, and until such time thereafter as the President may see fit to remove the restriction. So it's important to note that this restriction does not automatically expire after that 25-year time frame. The federal government must issue a second patent or other type of deed to restricted Indian land, which will specifically state that the restrictions are removed or that the land is no longer subject to those restrictions. If you determine that the property is still held in restricted status, it's necessary to obtain a certified title status report, or what we call a TSR, from the Land Title Records Office, and we refer to the Land Title Records Office as the LTRO. All records for land held in trust or restricted status are maintained by the Land Title Records Office. The process to order a title status report is detailed by our colleague Don Llewellyn in part 3 of this webinar series. Additionally, if you affirm that the property is held in trust or restricted status, there is no question as to the tribe's jurisdiction over that land. In that case, you have to consider the tribe's laws, regulation, and their judicial system when you're underwriting that transaction. Megan,
Thanks.
do you want to add another little tweak to this fact pattern?
Yeah, let's do one more. Okay. So let's say that when you're approached with the order, you're informed that the title to the property is held at unrestricted fee by the tribe, and they will be conveying the property to one of their tribal members under a tribal housing program that they've established. In that scenario, you must still consider access and jurisdiction, like we already talked about. However, there's a new hurdle due to the tribe's ownership of the land. The Indian Non-Intercourse Act, 25 U.S.C. 177, is a federal act which restricts Native American tribes from conveying, leasing, or encumbering land they own in fee without congressional approval or treaty. It's important to understand whether it is the tribe, a tribal entity, or a Section 17 corporation created by the tribe that's vested in title, as there are some nuances to the application of the Non-Intercourse Act on tribally held fee land. And you can learn more about tribal entities and Section 17 corporations in part 1 of this webinar series as discussed by our colleague Brandon Allen. Okay, so for this scenario, you confirm that it is the tribe itself that is vested in title to the property, and therefore you must consider the application of the Non-Intercourse Act. When a tribe is selling land they own an unrestricted fee, your underwriter may instruct you to raise a requirement calling for evidence of compliance with the Non-Intercourse Act. Some tribes have in fact obtained a congressional act authorizing them to convey, lease, and encumber their land. If they have not, your underwriter may require you to take an exception on the final policy for the failure to comply with the Non-Intercourse Act. This is a serious roadblock on many occasions, particularly if there's a purchase money lender involved. The lender and or the purchaser may be unwilling to accept a policy with this exception. Some tribes feel that the Non-Intercourse Act is not applicable to fee land. Unfortunately, this act is vague as to its application, and it has been interpreted by courts both ways. There is no United States Supreme Court decision on point, so the ambiguity persists. It's up to your underwriter to decide what their appetite for this risk is. The ALTA Native American Lands Work Group has made the pursuit of clarity surrounding the Non-Intercourse Act a legislative priority, with hopes that through a legislative fix, the issue can be resolved. Until then, it will continue to have an impact on development in Indian country. For additional details related to the Non-Intercourse Act, I refer you to Paul Cozy's discussion in part 1 of this webinar series. All right, I think we have beat that situation up enough. So we're going to now turn the presentation over to Nancy Appleby for our second hypothetical transaction.
Thank you, Megan and Cindy. Your discussion included a number of points that also come up in other contexts, and so we'll use our second hypothetical scenario to illustrate that point. Okay, in our scenario, or let me just back up one little second. In part 2 of this webinar series, we focused on leasing Native American land that's in trust or restricted status. One takeaway from part 2 was that trust land cannot be transferred even by lease unless federal law permits transfer. Congress authorized surface leases of Indian land in the Indian Long-Term Leasing Act, which is 25 USC section 415. The United States also regulates Indian land leasing under regulations in part 25 of the Code of Federal Regulations, which is the Indian law section, and the leasing regulations for surface leases are in part 162. Okay, the underlying aim of the Leasing Act and the regulations is to afford to tribes and individual landowners the opportunity to enter into leases of their land, while ensuring also that the federal government exercises its trust responsibility to protect and preserve Indian-owned land. As such, Indian land leases must include certain terms and cannot include others. Knowing whether a lease complies with the Act's and Part 162's requirements and restrictions is critical to ensuring an Indian trust land leasehold, subleasehold, and or a leasehold or subleasehold mortgage. Because if it doesn't, the lease may be void, causing the sublease and the lien purportedly granted by the mortgage to be invalid. Our scenario describes a residential subdivision developed on individually owned Indian trust land. In this case, it happened to be an allotment. Megan just mentioned Cindy just mentioned a lot of parcels. Operative documents in the scenario include a long-term lease from the individual Indian landowner, which we refer to as the master lease, and between the individual owner and the project developer, we'll refer to as the developer. The developer intends to divide the leased land into lots that the developer will then sublease to persons who in turn intend to build residences on their purchased lots. Homeowner financing will be secured by a mortgage on the homeowner's subleasehold. The lender will require title insurance to close the home loan. The takeaway from our previous slides is that transfers of Indian trust land that do not comply with federal law and regulation are at best invalid, and at worst, they are void ab initio. In our scenario, the master lease includes the following terms. The term of the master lease is 50 years with an automatic extension of 49 years. In other words, a total of 99 years. The developer or a successor homeowners association is given the right in the lease at any time 10 years or more after the date of the master lease to purchase the leased land for a fixed price of $500 per lot or $100,000 for the entire property. So what do? Before you insure either the owner's interest or the lender's interest, first, if the lessor into the master lease is an individual Indian landowner, which it is in this case, confirm that title is vested in that individual. Confirmation may require examining the patent to the original landowner and subsequent records that show vesting to and including the lessor. Patent records are maintained by the Bureau of Land Management, and they are available to the extent that they are online. They are available online. Not all BLM records, however, are available online. Other relevant records, for example, probate records, generally can be found in the BIA's Land Title and Records Office. Recall the presentations about the LTROs and TSRs during part 2 of this webinar series, and Orlando will touch on TSRs a bit more during his presentation. Okay, the second what to do is to confirm that the master lease is permitted by federal law. Section 415 limits the term of a lease for business purposes to 25 years plus an additional renewal of 25 years. Exceptions to the general 25 plus 25 rule that permit longer lease terms of up to 99 years are written into section 415. In our scenario, however, the leased property is not among the exceptions. As a result, its term violates federal law. Third, confirm that other provisions in the master lease, for example, the sale of the leased property, subleasing, and mortgaging, comply with federal law. Recall, the general rule is that tribal trust land cannot be sold, but allotments, the individually owned restricted or trust lands, may be sold by the Indian owner, but only on terms and conditions and under regulations prescribed by the Secretary of the Interior. You will find the relevant law in 25 U.S.C. section 404 and 25 CFR part 152, both of which you have the citations for on your slide. Part 152.24 requires an appraisal to set fair market value before the land is sold. Recall that under the lease in our scenario, the sales price for the allotted land is fixed at $500 per lot and $100 total, regardless of the appraised fair market value at the time of sale. This provision also violates federal law. Part 152 at section 152.17 and 152.22a requires secretarial approval of the sale of an allotment. And prior to approving the sale, the secretary must notify an interested tribe and tribal members that the land is for sale. In our scenario, the purchase option granted to the developer or the successor homeowners association disregards entirely the Part 152 preconditions on the sale. As a result, the option violates federal law. Additionally, any sale based on the option would have been invalid. In our scenario, as noted here and just a minute ago, our lease does not comply with federal law. So what's the result? The result is the master lease is at best, as I said, invalid, and a court might, or the BIA might decide to cure the violation or it's void, which is the more likely outcome if the tribe is not interested, excuse me, if the individual landowner is not interested in renegotiating the lease. Part 152 requires that fair market value be obtained for the land. The result here is that the option to purchase violates federal law. It's possible that the option might be deemed to be severable, so that it would not, the fact that it violated federal law would not necessarily poison the entire lease. However, that is not a given by any means. And in this particular scenario, there are a number of defects in the lease. And so the chances of having the severability clause save the lease is very, it really is diminished. And last, as I mentioned, the sale of any individually owned property is subject to secretarial approval, and it just simply is not provided for here. And finally, and this might give folks some pause, 152 requires that BIA give notice to an interested tribe. Someone tribe might want to buy it, and essentially, and buy the land rather. Essentially, the right in the tribe is a right of first refusal, and so the tribe has to be given notice and an opportunity to make the purchase before the non-Indian is allowed to purchase. So in this case, there is no notice involved. There is and there's no right of first refusal involved. And once again, the option, if it's not severable, will cause the lease to be invalid. All right, we talked just a second ago about getting federal approval. And here we've got a little flow that shows you where the approval starts in a leasing situation, where it ends. The rule, federal law, requires the Secretary of Interior to approve transfers, including leases and sales of individually owned land. Leases of tribal land also, if it's in trust, certainly need to be approved, and perhaps because of the ambiguity in the Non-Intercourse Act, fee land, if it's transferred, needs to be approved by the Secretary. The Secretary's authority is delegated and redelegated to specific officials. There is a delegation chain, and that delegation chain is set out in the Department of Interior's manual and in the Indian Affairs manual in Part 3, Chapter 4, and supplements. The appendix to Orlando's materials includes the relevant IAM pages. They also are available, the manuals are available at the BIA.gov website online. Note that the Secretary's authority gets redelegated down to BIA's regional directors. There are 12 of them. Then the regional director's authority may in turn be redelegated to agents and superintendents. And this is where the trouble can happen. Redelegations down to the superintendents, which are, it's the lowest field office for BIA, and each agency is in charge of overseeing and having the most personal relationship, if you will, part of the BIA with various tribes under its umbrella. The redelegation to the superintendent may or may not be published in the Federal Register. If the redelegation is not published, the regional director or superintendent ought to provide it to you so that you have evidence that the particular lease that you're working with is within the superintendent's authority, or should the superintendent be the one signing it. Redelegations also may limit a superintendent's authority. For example, the superintendent is authorized to approve only leases whose terms do not exceed a particular specific number of years. Sometimes an acting superintendent will approve a lease. The redelegation from the superintendent to the acting typically is an internal document that you'll need to request. We'll get a bit more from this on this rather from Orlando in just a few minutes. In our scenario, the master lease was not approved by the Secretary, even though it looked like it was. As a result, the master lease is void. The rule is that the BIA signatory must have actual, properly delegated authority to sign and hence approve on behalf of the Secretary. Apparent authority is not sufficient. That law is very clear. And so you need to be very aware and very careful of this particular point. The superintendent of the BIA agency in which the land is located approved the master lease in our scenario. However, the scope of the superintendent's authority is limited by the redelegation from the regional director to leases with a maximum term of 45 years. Recall, in our lease, we had a basically maximum term of over 90 years. And so the secretary's, excuse me, the agency's authority, the superintendent's authority, did not extend to that long a lease. So the result is that the superintendent's approval has no force and effect at all. Because the master lease is not federally approved as required, it is void ab initio and vests no property right in the developer. And because the subleases derive their purported subleasehold interest from the master lease, all of their subleases and subleasehold estates are void, and the purported mortgages granted to the subleases by the sublease lessees rather to the lenders fail as well. So our takeaway number 2 is, in brief, on this next slide. Leasing federal land, federal Indian land rather, Indian land in trust or restricted status is by definition subject to limitations and restrictions not found in other commercial transactions. Therefore, in addition to all that you know about commercial leasing, it's incumbent upon you to be familiar with applicable federal law, regulation, and delegation of secretarial authority. And I've repeated for your convenience the statutes and regulations that I mentioned respecting leasing and sales of allotted land. Your takeaway number 3 and 4. First, review every lease of Indian land with federal statutes and regulations in mind. Second, if you have any questions, consult your internal folks. Megan mentioned to ask your underwriter, just talk to your internal folks. Don't rely on advice from the BIA. That's very, very dangerous. There are many, many cases in which courts have said to folks who rely on BIA advice, sorry, but the person on whom you relied either didn't have authority to give you that advice or the advice is wrong. So don't fall into the trap of relying on advice from the BIA. Certainly speak with your folks internally and consult with them before you move forward. Okay, in just a few minutes, or just a minute, we're going to look at assigning and mortgaging grants of leases and rights of way over Indian land. Orlando's going to take a look at that, so stay tuned. Orlando will touch on provisions in part 162. Remember, that's the leasing regulation, respecting requirements of respecting lessor or federal approvals to a mortgage or to assign a leasehold or subleasehold or to mortgage a subleasehold. When you review the lease of Indian land, satisfy yourself that provisions in the lease, sublease, and or mortgage or assignment comply with Part 162 requirements. And Orlando will focus on that significantly more. But before we turn that mic over to Orlando, I want to change gears for just a minute to focus on governing law. In our scenario, The subleasehold mortgage that you're being asked to insure includes the following provision. Interpretation and enforcement of the mortgage are governed by the law of the jurisdiction in which the mortgaged property is located. As Megan and Cindy noted earlier, your consideration of zoning, ad valorem taxes, mechanics and materials liens, subdivision laws, and compliance all should take into account the tribe's regulatory jurisdiction over non-Indian owned land within its reservation. Whether the tribe has regulatory jurisdiction over non-Indian property within the exterior boundaries of a reservation is not always certain. In July 2000, the United States Supreme Court decided McGirt versus Oklahoma. McGirt was a criminal case in which the court held that the state of Oklahoma did not have jurisdiction to prosecute crimes committed within the Muskogee or Creek Nation's reservation in Oklahoma. However, notwithstanding that McGirt was a criminal case, and one might think that its impact would be limited, it's being read by many people to expand, or at least to open the door to an expansion of tribal civil jurisdiction over non-Indian land located within exterior boundaries of a tribal reservation. In our scenario, the governing law is of the jurisdiction, not of the state, in which the mortgage property is located. Reading McGirt expansively could mean that jurisdiction means the tribe's reservation rather than the state, which would result in the mortgage being governed by tribal law, or at least arguably so. Megan also mentioned that ALTA has developed the ALTA 47 endorsement series to address some issues that were raised by McGirt. If you want to take a deeper dive into the implications of the McGirt decision and the ALTA 47 endorsement series, I recommend to you the ALTA Commercial Networks program called The Dirt on McGirt, which was presented on September 8, 2021 by Megan and her colleague, Dan Buchanan. The recorded program is available on the ALTA website at the Education tab. The next segment of today's program will focus on additional issues that may arise when tribal trust land is developed by a third party. Orlando, it's all yours.
Thanks very much, Nancy. So as we're discussing already today, I'm just going to follow the progression of topics that my colleagues have already discussed. And in particular, I'm going to try to build upon what Nancy just discussed in the context of a more complex and sophisticated commercial transaction or an energy project. So this is our basic scenario. A wind energy developer has entered into an agreement with a federally recognized Native American tribe to develop a wind farm and transmission line on tribal land held in trust by the federal government for the benefit of this tribe. The deal will be financed by the lender taking a deed of trust in the developer's interests in the leasehold and easement estates, and the policy amount will be $500 million. The project comprises two components: a long-term ground lease on which the wind farm will be built, plus an easement for a transmission line to move the power to the electrical grid located on non-Native American land. As with many projects of this type, there probably has been much work done among the developer, the tribe, and the BIA before the transaction even comes to your title company for the issuance of a title commitment and the ultimate issuance of an owner's and loan policy. In and of itself, this timing can present issues for underwriting the transaction, particularly if the title company determines that the preceding work and documents maybe need tweaking in order to have an insurable transaction. So before drilling down into the specifics, let's just do some initial issue spotting around the basic principal issues. Since the land is held in trust, the search and examination of the public record will involve the BIA's Land Title Records Office, not the County Recorder's Office. This raises issues of timing and of the scope of the search and the documents to be obtained and the process for downdating the file before closing. Timing should be a big red flag to you. Since this transaction involves a federally recognized tribe, we understand that the tribe has sovereign immunity and that issues of sovereign immunity may arise in different aspects of this transaction. This also raises issues regarding the scope of tribal authority and the kinds of documents that are generally required to confirm the proper exercise of such authority. And as Nancy has already given us a tremendous introduction, there will be issues of which law applies to the transaction and to the insured mortgage and how that law affects the title policies. Given the federal government's trust responsibilities to the tribe, we know that the BIA will be an integral player. The BIA will have to execute and deliver a variety of agreements and approvals, recognizing that the tribe alone cannot enter and consummate this transaction. Since the BIA is responsible for the administration and management of trust or restricted status land, as Nancy has explained, the underlying easement and lease transactions to be insured must comply with applicable federal statutes and regulations. Section 415 and 25 Part 162 as to the lease, as Nancy has discussed, and 25 Part 169 as to the easement. These will be our guideposts for making sure that the lease and easement were properly created and therefore insurable. In addition, these same regulations address the mortgaging of those interests, and compliance with the regulations will ensure that the mortgage of the lease and easement will be valid and enforceable and insurable. So since any transaction that we're going to insure starts with a search and examination of the public record, and as the prior speakers have already noted, we begin with the LTRO. As our colleague Don Llewellyn already described in Part 3, when the land that is subject to the commitment is trust or restricted status land, the public records search is conducted in the BIA Land Title Records Office, or the LTRO. And this is the repository of records that constitutes the official record of title documents and instruments affecting title to native lands. So even though these documents may also be recorded in the county recorder's office where the land is located, county recording does not constitute an official record with respect to native lands. So the first step in this process is to determine which is the correct LTRO office from which to request the search. And there are 18 LTRO offices across the country, and the correct LTRO office can be easily identified on the landing page of the BIA's Division of Land Title and Records website, which is reproduced in this image. For example, in my home state of New Mexico, the LTRO office is located in Albuquerque and services all of the New Mexico Pueblos, the New Mexico Apache tribes, the Hopi tribe, and the Navajo Nation. Some tribes, such as the Cherokee and Choctaw in Oklahoma, have their own LTRO offices, and a listing of such offices can also be found on the same landing page. As Cindy already noted, the search document produced by an LTRO office is a title status report, or TSR, and a TSR may be certified or uncertified. As the name suggests, an uncertified TSR is an uncertified and unverified report of ownership and encumbrances as shown by the title data in the TAMS database, which is a national database used by the Department of the Interior to manage trust assets. On the other hand, a certified TSR is a report of ownership and encumbrances that is certified as true, accurate, and up to date based on the examination of title documents recorded in the LTRO and in TAMS. While an uncertified TSR may be sufficient to prepare a preliminary title commitment and provide preliminary information to the parties, most underwriters will require a certified TSR as a condition of closing these transactions. When dealing with an LTRO, timing is key. A title company cannot search the LTRO. The TSR must come from the LTRO itself. In my experience, obtaining certified TSRs from an LTRO can take much longer than the typical search and examination of county records. Even an uncertified TSR for a large commercial transaction can take months to receive, and the process is not necessarily straightforward. So, as has been discussed previously, having a good relationship with someone at the LTRO could facilitate the process, but that is less true nowadays. Particularly if you are dealing with parties unfamiliar with native lands transactions, it is very important to advise the customer early in the process that it may take many months to issue a title commitment because of the time it will take to obtain the TSRs. This next slide features the cover page of a certified TSR. First, note the date and time of the report certification. This is equivalent to the date and time that a search of the county records is completed. On the top row, there is basic information about the TSR, including the land area, which is the tribal number. This identifies the tribe. The land area name, typically the name of the tribe again. The tract number refers to the status of the land. Here, the T stands for trust. And then the next two items identify the LTRO office that issued the LTRO and the particular agency. The next full paragraph identifies the restricted status of the land and states that only properly approved encumbrances have been recorded and described in Exhibit C. The TSR excludes all matters that would be revealed by a physical inspection or survey. And then the last paragraph is the certification language, saying that the TSR is a true and correct report of the status of title. One of the practical challenges of dealing with TSRs is the downdating process. We are all familiar and understand that title companies downdate a file close to the time of closing to identify any new matters that may have been recorded and which may affect title since the date of the search and examination that produced the title commitment. Because of the great delay in the LTRO process, it is almost impossible to get down dates that are close to the date of closing or the date of policy. And that gap becomes a risk that may be assumed by the underwriter. The two short estates in our example will be a leasehold estate for the wind farm and an easement estate for the transmission line. The deed of trust will be secured by both the leasehold and easement estates. Similar to any other transaction involving leaseholds and easements, this transaction raises the issues of the validity and enforceability of the lease and of the easement, as well as the validity and enforceability of the deed of trust secured by these two estates. Because this is trust land, however, there is the additional overlay of issues related to the authority of the tribe and of the BIA with respect to the lease and easement, and the authority, as Nancy has described, to create a deed of trust on those interests. In order to ensure this transaction, the title insurer will scrutinize the tribal and BIA authority documents and the documents that created the lease and the easement. Nancy has already provided us with a detailed discussion of the operation of the federal leasing laws, and so I'm not going to repeat those again. However, for purposes of this presentation, we are assuming that this tribe has not enacted its own tribal leasing regulations under the Hearth Act. And to refresh your recollection of the Hearth Act, please refer to our colleague Rolf Lindberg's presentation in part 2 of this program. As has already been discussed by Megan and Cindy today and Paul Cozy previously, the Non-Intercourse Act prohibits leasing or other encumbrance of Native American lands except as expressly permitted by Congress. In our hypothetical, the lease for the wind farm would be a lease for a business purpose under Section 415, and specifically a wind or solar resource lease, which has its own set of regulations. Since our hypothetical involves two insured estates, a leasehold and an easement, each has to be evaluated on a standalone basis. As Nancy has already noted, generally a lease cannot exceed a term of 25 years plus one option to renew for an additional 25 years. In this example, however, we assume that this transaction involves a tribe that is expressly authorized by statute to enter into a 99-year lease. But as you see in our example, the insured lease and the insured easement will not have coextensive terms because the easement will be able to be renewed for an additional 99 years. So in addition to reviewing the applicable regulations and laws to confirm that the lease complies, as Nancy noted, an insurer is also going to be including requirements that are typical for any lease transaction, such as a requirement for a lessor-lessee estoppel certificate, and to confirm that any further lessor consent is not required to mortgage the leasehold. In my earlier presentation in part 3, I discussed the federal easement regulations, which are the basis for an insurer's review of the easement estate to be insured. Typically, the documents associated with an easement will include an agreement between the tribe and developer easement holder, a tribal resolution authorizing the transaction, and the BIA grant of easement, which actually creates the easement to be insured and incorporates the agreement between the tribe and the easement holder. The term of the easement will be as stated in the grant, and the BIA will defer to the tribe's determination of what term is reasonable, though the BIA generally considers a maximum term of 50 years, inclusive of initial term and renewals, to be reasonable. But as noted, the BIA will generally concur with whatever the tribe thinks. In this transaction, we're seeing a 99-year lease with an option to renew for an additional 99 years. Even though the BIA is the party to grant the easement, in order to grant the easement, the developer must have obtained tribal consent. In practice, the BIA's grant of the easement will be consistent with and subject to the terms and conditions of the agreement negotiated between the developer and the tribe. That agreement will be similar in form and content to any other commercial easement agreement, and any restrictions or conditions in the agreement automatically will be included in the BIA's grant of easement. As we have already learned, tribes are sovereign nations and are typically governed by a tribal council and led by a governor or chief. The agreement between the developer and the tribe must be approved by the tribe's governing body, so that the title insurer will review the tribal constitution and other applicable laws to confirm that the tribal resolution or authority document is consistent with and in accordance with the tribe's own laws, and to confirm that the resolution and agreement were properly executed and delivered. This slide restates language from an actual tribal resolution approving an easement. As you see, these are recitations of the negotiation and existence of the underlying right-of-way agreement, and confirms that the tribe consents to the Secretary of the Interior granting the easement. This language expressly approves the form of the easement and expressly authorizes the BIA to execute the easement. It further confirms that the authorization was enacted at a duly called meeting of the governing body and reflects the vote at that meeting. In addition to the issue of tribal authority, there is the issue of sovereign immunity. In our hypothetical situation, the lease and easement documents include the limited waiver of sovereign immunity shown on the slide, though as you will note, this is not directly for the benefit of the title insurer. Waivers of immunity can be an especially thorny issue for a lender who does not want its ability to foreclose a mortgage to be impaired in any way by potential issues of tribal immunity. Depending on the transaction, a title insurer may also seek a limited waiver from the tribe, even though the tribe is not the insured under the policy. As noted, the BIA is the federal agent that will execute the grant of easement. But as Nancy has already given us a great history, this is all handled through the BIA and through the series of redelegation orders. So in order to confirm the authority of a particular superintendent, it is appropriate to require a copy of the redelegation orders under which a particular superintendent acts. Though as Nancy has alluded, that can be easier said than done, and can become particularly complicated if there is an acting superintendent. In a recent transaction, this issue literally took weeks of effort to sufficiently get comfortable with the authority of an acting superintendent. And we had to confront repeated statements from the BIA that an acting superintendent has all of the same authority as a permanent superintendent, which, as Nancy has shown us, is not necessarily true. Here is I highlight some sample delegation language from an actual grant of easement. The references to DM mean a specific BIA department manual, but finding that underlying manual isn't necessarily an easy task, even if you know where to look. So here, the particular reference to 209 DM8 is to a 2003 document, and this particular reference is part of a series of department manuals related to delegated authority, as shown on the following slide. In the context of our hypothetical situation, the power delegated in item 3 is especially relevant in light of the fact that a leasehold mortgage will be insured in the loan policy, which leads us to assignments and mortgages. The ability to assign and to mortgage the insured leasehold and easement estates is critical to a title insurance transaction. If the interest cannot be assigned or transferred in the future, that might trigger a claim under the marketability provisions of an owner's policy. Likewise, if the interest cannot be mortgaged, that means that a mortgage or deed of trust secured by these interests would not be valid or enforceable. With respect to the lease, a future assignment or sublease generally requires satisfaction of consent requirements and BIA approval of the assignment of sublease, though there are certain assignments and subleases which do not require further BIA consent or which provide for deemed consent. With respect to future assignments and subleases, typically there will be some exception that recognizes the particular limitations on the assignability or subleasing associated with the particular lease, though the BIA cannot unreasonably withhold its consent in the future. By contrast, an easement may be assignable without further BIA or tribal consent. For example, this assignment provision from a grant of easement permits future assignment without further BIA approval or the payment of additional compensation. This is the kind of provision that insurers like to see. It is nonetheless subject to compliance with certain conditions of the underlying right-of-way agreement with a tribe, so an insurer must understand what those conditions are and confirm that they are satisfied. Here, there is also the additional condition of having to provide a copy of the assignment and supporting documents to the BIA within 30 days of the assignment, a potential gotcha. Likewise, the mortgaging of the leasehold estate and the easement estate must comply with applicable federal law. Like assignments and subleases, a leasehold mortgage is subject to notice to and consent by the tribe and approval by the BIA, which cannot be unreasonably withheld. There can be more flexibility with an easement. In our hypothetical, the grant of easement contains a mortgage provision that is nearly identical to the assignment provision and permits mortgaging without further BIA consent. Interestingly, in this particular example, the last sentence includes the 30-day period, but does not identify what the triggering date is, though presumably it is 30 days from the execution and delivery of the mortgage. So as Nancy in particular has already emphasized, when insuring a transaction involving tribal land, there will be questions of what law applies, particularly after McGirt. So I'm not going to elaborate further given Nancy's discussion of that. So let's move on to recording the transaction. The lease or a memorandum of lease and the grant of easement must be recorded in the LTRO that has jurisdiction over the land. The tribe or the BIA will be responsible for recording the instruments. Timing again can become an issue because there can be a substantial lag between the closing date and the date the documents are recorded in the LTRO. From the perspective of title insurance or insurers, there is a preference for also recording the instruments in the county recording office, even though that is not required or addressed by federal law. And even though recording in the county recorder's office is not the official and operative constructive notice of the instruments, as only recording in the LTRO provides that, there is the practical benefit that future searches in the county records will identify the transaction and alert a future insurer of the need to go to the LTRO. To briefly summarize, when insuring a transaction involving a lease and/or easement of tribal trust land, the title insurer will focus on the creation of the insured lease or easement to confirm that they comply with federal statutes and regulations, that they were properly authorized by the tribe, that they were authorized or executed by the proper BIA official, that they contain appropriate assignment and mortgage clauses, that they are in full force and effect through an appropriate estoppel certificate, that there are no tribal laws that affect the insurability of the interests, and if so, that those have been properly accounted for in the policies, either as commit requirements or exceptions, that appropriate waivers of sovereign immunity are in place, that the terms and conditions of the insured lease and grant of easement are Schedule B exceptions, that any future consents or approvals are included as Schedule B exceptions, and that all instruments are properly recorded in the correct LTRO office. While this has been a very quick run through of this hypothetical and has not addressed every issue in detail, I hope that it has at least raised your awareness of the detail and complexity that goes into evaluating all of the many, many title insurance issues that arise in this type of transaction. So I think we now are open to Q&A. Jeremy, do we have any?
All right, well, thank you, everyone. As you concluded there, Orlando, a lot of layers and complexities when handling a transaction that involves Native American land. I know we already are at the top of the hour. We did get a few questions come in, and if we don't get your question, send an email to communications@alta.org. We'll get it to the speakers and get it answered and get the information back to you. In regards to LTROs, Paul had asked, when speaking of the LTRO record search, is it clear that title industry personnel have access to those records? Is any written consent or authority grant necessary as a prerequisite to the title industry personnel gaining that access?
Okay, so in response to the first question is, the title insurance personnel do not have direct access to those records. So it's not like your title examiner goes to the LTRO records and can search and examine those records themselves. Rather, the request is made to the LTRO. We need a certified TSR for this legal description of land that we already will know is trust or restricted land. And so someone at the LTRO office actually does the search and examination and prepares the certified TSR. So we are relying on the work of someone over whom we have no control or influence as a practical matter. We are trusting that everyone at the LTRO is competent, knowledgeable, and is doing their job as we would expect. So, and again, I think to answer the second part of the question is, the title company generally is not just going to be able to call up the local LTRO office and say, I need this. They are going to have evidence that the tribe, probably maybe through the real estate office, has okayed this request for a TSR.
Yeah, I just want to add to that they recently, the regulations governing the land title record offices had been modified, and that was the first modification in over 20 years. And one item that was specifically addressed when they modified those regulations was requesting of the title status report, because there was some inconsistency depending on what geographic area you're in and what office you're going to. And some LTRO offices would take direct requests for title status reports. They no longer want people to do that. The regulations specify that you should be going to the local BIA agency office to make the request for the report, and then they in turn will contact the LTRO to get your report ordered for you. So they're sort of acting as a liaison between the title insurer or the mortgage company, or whoever is making the request, and the LTRO. And the title insurers are recognized as entities that need information in order to insure transactions that involve tribes or tribal members. And so the LTROs are aware and used to working with our industry.
Okay, all right. Thank you for that explanation. I guess, as you work with LTRO over time, you do gain that trust. Trust and liability seem to be two things that are often hard to reconcile. We haven't received any other questions, so I think you guys did a pretty thorough job of walking through the nuances and explaining the scenarios. And definitely one of the messages that you guys shared was, if you are handling a transaction, have questions, work with your underwriter and seek their guidance, as they've probably handled these types of transactions in the past. Transition here. Here's the information on the first two webinars, and definitely want to acknowledge and thank you all, as well as the other members of the Native American Lands Work Group that have taken their time and shared their expertise in the prior three segments and this one as well. So again, thank you to you four and your other members of the group. As a reminder for everyone who's still with us, you'll get an email tomorrow with a link to the recording, as well as the links to the recordings of the first three webinars of this series. And as you can see, the URL for the webinar is alta.org/webinars, and you can access ALTA's archive of all our presentations. Any parting comments? Otherwise, thank you for this wonderful in-depth series on insuring Native American lands.
Thank you.
All.
Thank you all.
We appreciate the support from the ALTA and folks who have viewed and are now viewing the webinar. We very much appreciate you, and look forward to continuing to work with you on this sort of project.
Okay. All right. Well, thank you very much. And that will bring us to the conclusion of today's presentation. Take care, everyone.
Bye.
Bye.